Hey everybody, welcome to the Everything Money Show with Seth and Paul. We are here today looking at Revolve, the clothing company. Revolve Group Inc. Their stock has been doing really well. We took this one from one of our fans. They said, you guys have to take a look at this. And Paul and I are decided to use our 8 pillars to look at how we're going to evaluate this stock and the health of a company. So if you're interested in Revolve, you're going to learn right now about, is this stock a buy or a sell or a stay? And I introduced my dear friend, Paul. Welcome, my friend. He's here as really my backup, my co-host. I'm really the leader of the show, Paul, and we're gonna use this. I kind of have this dumb sidekick that I'm gonna cut to every once in a while.
I'm Andy Richter.
Yes. So, yes, thanks for joining us, Paul. Let's use our 8 pillars. What is the market cap of Revolve? What do you know about this company besides clothing? I mean, I know they've used Instagram influencers to grow their business. It's been pretty exciting.
Yeah, and that's been the big thing. I don't think they spend a lot of money on advertising. I think we'll see that in their profit, but. Basically, for start, $1.4 billion market cap. For those of you who don't know what that is, I never look at stock price except when I decide at the very, very end, what's it worth divided by shares. This is what you're paying for the company, $1.4 billion. When you buy a company, when you buy a stock, you're buying a piece of a company. So you have to worry about you have to look at what the company is selling for. $1.4 billion is the number of shares multiplied by the current stock price. Okay.
Pillar number 1 is PE ratio. Our pillar number 1 is PE ratio less
40.
than 20. Uh-oh, Paul. What do you think?
Well, I mean, it's expected for a very fast-growing, exciting company that people are talking about. 40 is going to be, it's going to be a high PE. I don't like that. Doesn't mean it's a no. Remember, companies that are growing very, very fast can have higher price-to-earnings ratios.
Okay.
So we're still going to call it next. 10% profit margin in the last quarter.
This is pillar number 2, profit margin.
Now, but in the last year, I'm going to take this X away.
Go on.
Well,
this
is a weird one. I'm going to still call it next, and here's why. In the last 12 months, they've only had $36 million in profit on $600 million in revenue, which is 6%. Mm-hmm. Okay? Now, the one thing I like about them, 50% gross margin.
What does that mean?
That means for every dollar they sell extra, they're getting 50 cents of that to the bottom line in profit.
Compare this to, I'm drinking Coke as I host the show. Hey, everybody. Compare this to other companies, Paul, like IT versus retail.
So a company like Microsoft has really high gross margin because it's software. Once you make the software, it's done. Most companies... What's so funny?
It's just like both of us are drinking water mid-sentence.
I don't know. It's not nothing. There's no gross profit or profit margin that makes it a be-all and end-all buy. But obviously, like the more profit you have and the more gross margin you have, the better you can withstand, dips. Now, the other problem, though, is the bigger the gross margin, the more the competition, because people see high gross margin and go, oh, listen, I want to get in that business.
Let's get into pillar number 3, which is revenue growth over the last 5 years. Now, have this company even been around for 5 years?
I don't know if it has.
I assume the revenue is pretty awesome.
Okay, revenue growth the last 3 years. That's when it's been public. Or that's when the financial data is available for. 400, 500, 600. Check mark.
You like that, right?
Of course. Profit 5.3, 30, 35. Now, the one thing I like about this is a new company and it's already showing a profit and the profit's growing.
Why is that? Normal company?
I mean, usually growing companies try to spend all their money trying to grow. So they take losses and it's justified by massive growth.
How about number of shares? Pillar number 5 is number of shares outstanding. We want this decreasing.
Surprisingly, in a small company, it is decreasing. Check mark. Usually you don't have this small company. They want to make acquisitions. They're a sexy story. The people they acquire want to have shares in the new company, et cetera, et cetera. So usually this doesn't happen. Also a check mark there.
For our lovely new subscribers like the ones watching right now, Paul, why do we want that number going down?
So we always have to talk about this. I always forget that. When they're issuing more shares, they're basically hurting your ability to get their revenue and profit. So, for example, if there are 10 shares...
If I own a share...
So if there's 10 shares in the company and you own 1 share, you own 10% of the company, right?
Yes.
If tomorrow they make an acquisition and in that acquisition they just create 5 more shares, now they have 15 shares outstanding, you still own your 1. Mm-hmm. But now you own 6% of the company or 6.6% of the company as opposed to 10%. Mm-hmm. So they've done what's called diluted you. So they've taken your ownership from 10% to 6.6% like that. It's different than a stock split. A stock split is different when they split everything in half.
I'm glad you said this.
That doesn't hurt you.
Both are confusing, yeah.
But you can go from 10 to 20 shares outstanding without doing a stock split, when they just issue more shares to make an acquisition. Like, oh, hey, Seth, we're going to buy your company and we're going to give you 5 shares of ours. Oh, great, I love that. Thank you very much. But meanwhile, I'm a shareholder at 10 shares. Now all of a sudden I'm a shareholder of 15, 1 shareholder of 15 shares.
Yeah.
That sucks.
Let's go to pillar number 6, is current assets greater than current liabilities. Paul, why do you like looking at this?
I want to make sure that they have enough cash on hand, which is the total current assets, 240 million to at least pay their current bills, which is their total current liabilities. Now here's the great news. Their current liabilities, they have 120 million check mark, but even better, they have no long-term debt. Look at that. Long-term liabilities, $0. That is awesome. So this is a young company that's growing, showing a profit, and not taking on debt. This is a very big plus.
Before we hit the last two pillars of the championship rounds, Paul.
What would you like them to hit?
Folks, let me real quick. If you can go to the bottom right, kind of right middle of your corner, and smash that like button, pretty please. All you gotta do is hit that button, subscribe if you want to hear more of this expert analysis. I would say that if you're watching and you don't know, this is not Graham Stephan, this is not Meet Kevin, where we plan out the whole show. Paul and I, this is all live, baby. We're switching and doing this live. This is all Paul's knowledge, using the Y charts and getting knowledge on these stocks. If you love what you're seeing, you don't have to pay us any money. Just have YouTube pay us by smashing that like button. Paul, let's do the last two pillars. Pillar number 7 is free cash flow growth, baby. Tell me about it.
14 million, 23 million, 34 million. So definitely a check mark there. The average over the last 3 years has been 37 and 34 is 71. Divided by 3 equals 23 point whatever times 20.
Okay,
now this one,
so
I will
is
say,
free cash flow average over every last 3 years.
So we want to multiply that number by usually 20. This is a faster growing company. I think it can justify a higher multiple of free cash flow.
So what Paul's talking about is our last pillar. Pillar number 8 is the price to free cash flow over the last 5 years. We want that to be less than 20, so that's why we're multiplying by 20. But you're multiplying by 25, Paul.
Let's call it $600 million. Now, the reason I call it that is it's still selling for $1.4 billion.
Yes.
So it's overpriced right now, which is not a shock. I'm not saying I'm right. For me to really look at what's going to happen, if this company were to keep growing like this for the next 10 years, you can justify paying $1.4 billion today, or the stock price for you out there, $20 a share. You can justify that. The question is it going to keep growing 30, 40% a year for the next 10 years?
The question is, what do you think?
I don't know. My philosophy in investing, which I'm not saying should be yours, my philosophy is to find a more mature company that has a much more stable and boring story. But I know that every single day I'm going to get that check year in and year out. And that's what I want to look for.
This is like Boeing, Verizon, AT&T.
Bigger companies, whatever they are. That's more sexy to me, where I go, oh, great, I'm going to buy this company, shares in it, and then I'm going to go away for a year and wake up, and if the stock price has gone up a little, I know that my shares have now increased in value, and eventually I believe the market will listen to the value that's being shown and will make the stock price reflective of that.
I'm certain the momentum chart will show us which way we're headed, and maybe with some play money, Mike. With some play money.
This is a great idea for play money. Don't put a lot of money in this, but put some fun money in it.
Go ahead. Show me what this graph is.
So we want to look for when the 50-day moving average goes above the 200-day moving average. That happened right here. That was end of July at around $15. So over time, if you bought when the 50-day moving average goes above the 200-day moving average, if you consistently do it without fail, over a 20-year period, we backtested this, you beat the market. Not by a ton, but you beat the market. But you have to stay consistent. You'll have a lot of small losses along the way, but when you do hit a good one, you'll make a lot of money. If you had done this at $15, right now you're at $19, you'd be sitting pretty. So there is positive momentum. It seems like the positive momentum is starting to flatten out a little bit. As you can see, the lines are becoming more parallel. And so maybe the momentum is waning. But the whole point is, if you'd bought at this point here, you'd have done pretty well for right now. And then once it goes below the 200-day moving average, you get out of it.
For our viewers, if you've just subscribed, you're newly watching, let me preface this. I'm a wedding photographer. I know nothing about this stuff. My whole life, if I bought or invested, it was on the stock price. What is the price at? I got lucky in buying some stocks, Paul, but I've learned from you for the past 2 years, and you as a viewer and subscriber can certainly learn from your Uncle Paul about everything there is to know about stock analysis. Again, we're not trying to find stocks to buy. We're making sure we're buying really great ones, right? We're trying to hit those 20 to 30 amazing stocks while saying no to thousands of them.
You have to stop looking at a stock as a ticker symbol. You have to start looking at it as a business. For example, look at a stock like your wallet. If your wallet was selling tomorrow for $100 and there was $100 in it, you'd be happy, right? You'd be like, okay, I bought it for $100, it's $100 in there. You wouldn't be happy. You'd be like, okay, I paid a fair amount. For some reason, a company is like your wallet. If we keep throwing money in there and the price stays at 100, but now there's $300 in there, are you happy or upset that the wallet holds $300 in it?
Of course happy.
Yes, but with stocks, for some reason, we look at the bank accounts of the companies and we go, yeah, but that's not my money. It is your money. You own a piece of that money. You own a piece of that cash flow. You own a piece of those bank accounts. That's the way you have to look at it.
That was incredible, Paul. I like
You
what
like
you're
that?
saying.
Yeah, Tim did a little
Damn.
raise the roof.
Thanks, guys. As always, follow us on YouTube, like and subscribe. We go live Tuesdays and Thursdays at 1 p.m. Eastern. We have so many amazing things coming in the future. A Patreon page, an app where you can analyze all the stocks right on your phone. And as always, thank your Uncle Paul and Uncle Seth. Love you, Paul. Let's do it, baby. Thanks. See you guys.